In the context of Kanye West being dropped by Adidas, let's have a look at the Adidas stock performance and its potential. It has fallen by around 70% from its peak, but does this offer a potential profit-making opportunity if the stock is bought now? Stay tuned to find out the most valuable information on the topic, and as always set with educational purposes, and it is not meant to be taken as financial advice. Adidas is the second largest sports brand in the world. The first place is taken by Nike with about 44.5 billion in revenue, and Adidas is in second place with 23.5 billion, while spot number 3 is taken by Puma with about only a 6.2 billion in revenue. According to Fortune Business Insights, the global sportswear market will grow by 6.6% annually until 2028. Other sources give future predictions of about 3 to 8% global growth of the apparel industry. Behind the underlying fundamental growth of the industry are several factors such as number 1, the surging female participation in sports, on second place the increasing health consciousness among the population worldwide, and the third reason is the surge in online sales, which is a net income growth driver. This boosts Adidas' margins as there is no need for expensive physical stores and extra personnel costs. Women and children segments are experiencing positive growth due to an increasing number of sports and physical events catered especially for them, according to Fortune. Another trend on a substantial rise is the increased health awareness. Just in 2020, after the pandemic, the growth in fitness-based apps has surged to a record high and grew by 50%, according to data from the World Economic Forum. The global share of types of sportswear is as follows. About 33% goes to footwear, around 65% goes to clothing, and about 3% or so goes to wearables. A risk for the sportswear market from a higher growth perspective is the increasingly high counterfeit market. The OECD stated in 2019 a study that 3.3% of global trade is made through counterfeit goods. In that number, a high amount goes to clothing and food apparel. Let's now analyze in more depth Adidas. Its top-line revenue grew by 4% in Q3 of 2022. The best result is seen in its football segment, as the World Cup in Qatar is a driving force for more jersey sales. Another top performer is their running sector, with products like ADDYY and Supernova being top sellers, while the category grew by 50% during this quarter. When it comes to geographical markets, the top performer in terms of growth is Latin America, then comes Asia Pacific, then go the Western markets, Europe and North America, and then is China. Adidas stated in their Q3 report that their forward-looking guidance is seeing increased lack of demand from worldwide consumers due to economic contractions. Also, as a risk for their business profits, they see inflation as a big problem. A big problem I see for me personally is this next statement in their press release. Adjusted net borrowings in September of 2022 amounted to 6.4 billion euros compared to 3.26 billion a year prior. This is an increase of 3.14 billion euros. This development was driven by the decrease in cash generated from operating activities, the dividend payment, as well as by the company's share buyback activities. Here the company is saying their business is suffering from decreased cash generation, and in times of higher interest rates, they need to take on more debts in order for the business to function in a proper manner without any disruptions. Also, they mention the dividend payment, which is a burden to them currently, as this is again indicated by the fact they need to take on more debt. Also, the company states their share buyback activities, and over the course of this and last year, their share price buybacks have destroyed a lot of shareholder capital money. This is due to the fact that share buybacks are truly effective and efficient ways to boost shareholder returns only if done when the company is trading below its fair value. Adidas has fallen by 70% over the course of this 1 year, hence the buybacks are done mostly at much higher prices, which does not create value to shareholders. For this year, Adidas' net income is expected to be in the magnitude of around 500 million euros, with previous figures being 1.3 billion. This is quite the ramp down. They attribute $500 million to one takeoff losses, which occurred during the year, and their guidance for 2023 is that they expect to compensate cost headwinds of up to 500 million euros. This will give us a total net income profit of about 1 billion euros. Okay, now that we have all of this information, let's make our fundamental analysis. By the way, if you learned some interesting and new facts during the way until now, and you think I deserve your subscription, please subscribe, as this greatly helps the channel to grow. Anyway, let's get back to Adidas. The current market cap of Adidas is 23.5 billion euros. If during the forward 1 year net income is 1 billion, this gives us a forward PE ratio of 23.5. This means the earnings yield of Adidas is going to be 4.25%. The current dividend yield is 2.7%, and our total investment yield on a fundamental basis is the earnings yield plus the dividend yield, which gives a total return of about 6.95%. But we must check if the dividend is sustainable. For this year, the dividends paid out total 610 million euros. This is more than the total net income of the company, which says the dividend is unsustainable. If the dividend does not get increased during the following year, it would still be 610 million, and if the net income goes to 1 billion, this would give us a dividend payout ratio of 61%. We find this when we divide the dividend paid by the total net income. All these assumptions come hand in hand with a lot of ifs. At the same time, Nike has a dividend payout ratio of 33% according to Guru Focus. This means that the dividend from Nike is much safer from the standpoint of it being cut. Also, there is a much bigger chance the Nike dividend will get increased as they can afford to do it. It is always good for most industries to have a dividend payout ratio below 50%. Although the current dividend of Nike is lower and it stands at 1.32%, while its forward PE is 30, so the valuation is quite high. In terms of competitor supremacy, Nike definitely has the so-called higher competitive moat, but Adidas has also some moat in terms of detracting competitors stemming from its strong and recognizable brand image. When analyzing the current ratio of the company, it stands at 1.34. Above a 1 is considered a good level, as this shows us the short-term health of the company. The quick ratio is a more conservative metric for analyzing short-term debt health, and it subtracts the inventory from the total current assets. In the case of Adidas, it is 0.76. Above a 1 is again optimal, but the current level is also okayish. The long-term debt-to-equity ratio is 0.96, which is just on the brink of being too high. Above 1 is not optimal, and below 0.5 is the best place to be. From a debt perspective, I am not fond of what I see from Adidas. The last piece of the fundamental puzzle is to check the company's efficiency ratios. The return on invested capital for Adidas is 12.8%, while the return on equity is 18.2%. Both of these metrics need to be above 12%, according to the great Warren Buffett. These returns here are also a bit skewed, as Adidas has a lot of debt which lowers its equity, and thus this gives higher returns. In general, Adidas has too much debt for me, and the uncertainty surrounding its future earnings is very concerning to me. Also, the valuation is not that low. If the stock price falls by 30 to 40% more from here, then I'll make a newer analysis and see what is the current and future prospect for the company. I hope you extracted value from my analysis. Subscribe if you're interested in these kinds of topics and share down below in the comment section which other stocks you want me to cover next. Goodbye for now and until next time.